All right. I think, Jonathan, you want to get it going?
Yes. You ready?
Ready to go.
Good afternoon and welcome to the first astr60, Smarter Biotech, Better Outcomes for Patients. Anyone who has been around this industry knows the numbers. Biotech is tough. Costs are high. Risk is everywhere. The failure rate has hovered around 90%. By any measure, that would make this one of the hardest businesses in the world. And yet, I believe this may be the most exciting time in biotech's history. We are living through revolutionary change. From the mapping of the human genome to the rise of AI, from smarter trial design to new models of capital formation, the ground is shifting beneath our feet. The rules of the game are being rewritten in real time. That is why we created astr60. It's a platform for ideas and conversations that matter, delivered in under 60 minutes. We want to spotlight the voices and the tools that will define what I sometimes call Biotech 2.0. For me, this is also personal. I've been fortunate to spend more than 30 years in this community. The friendships and partnerships built over that time are a foundation of Astr Partners. Trust is at the center of what we do. Whether it's IR, strategy, capital advisory, or board level counsel, astr60 is a way of sharing that trust and those relationships with the wider community. So let's begin. I'm delighted to introduce today's moderator, Hartaj Singh, a respected voice who bridges science and Wall Street and the perfect person to lead today's discussion. Thank you.
Great. Thank you, Jonathan. And it is great being one of those connections, friendships, and working with you professionally over the last 30 years. It's been an amazing ride and will be an amazing ride to continue, I imagine. Just before we begin, I just want to sort of welcome everybody to the first episode of astr60. I just want to say, make a quick note on the behalf of my firm, the panelists, GATC Health and Astr Partners. The discussion today is for informational purposes only. The views expressed are those of individual speakers and not the employees or employers. This content should not be taken as investment advice. So, let's get going. I've been lucky enough to spend about 20 years on the sell side and the buy side here in Wall Street. Just crossed my 20th year. And this is about as exciting a time as I've ever seen, especially in terms of AI and what the potential it has for biotech. And so looking at the big picture, if you really think right now, a third of publicly traded biotech companies are now at negative enterprise value, meaning investors see them as worth less than the cash on their balance sheet. IPOs are shut, secondary financings are selective, and the private venture dollars are tighter. In this environment, capital efficiency isn't just a virtue, it's survival. At the same time, the regulatory landscape is under strain. The FDA faces political crosswinds and resource constraints, while AI technologies are moving faster than policy can keep up. Amid these headwinds, AI has emerged as one of the few practical levers companies can pull. It's not a buzzword, but it's a toolkit for smarter, earlier, and lower risk decisions. Now, this brings us to GATC Health. I've gotten to know this company a little bit over the last few weeks. Really, really exciting stuff. Unlike for many AI for biotech concepts still on the whiteboard, GATC is operationalizing AI in a tangible way. Its platform simulates human biology across multiple omics layers: genomics, proteomics, metabolomics, and transcriptomics, shifting the model from make then test to predict then make. The ambition is straightforward: making drug development faster, safer, and most cost efficient through rigorous predictive testing. Early traction with both academic partners and financial backers shows that this is just not a theory. It's the start of a new model for supporting and funding clinical trials. And we desperately need that. I think a lot of our panels will talk to some of that, that our industry needs to get better with our resources and the capital we have. Now, this raises the central question: is GATC an example of the next wave of AI native biotechs, where predictive modeling changes how capital is allocated and risk is managed? That's really what the discussion is about today. We look at the capital challenge, the regulatory implications, the operational impact, and the investment outlook. How can AI tools improve go, no-go decisions? How will regulators adapt? What are the practical values for boards and CFOs? So, just to close, I'll ask each panelist to share their perspective on these exciting developments in biotech, even if they unfold at classic biotech speed, which we're hoping to make fast with AI. So with that, I'll turn over to Tomas.
Thanks, Hartaj. My name is Tomas Phillipson. My background is I'm an economist by training. I was a chaired professor at University of Chicago for many, many years. I was also a chief economist at FDA and CMS and co-founded a company that served the analytics of the 50 largest pharma companies, which we exited in 2015. Blackstone currently own it. And then I went to the White House as a member and chairman of the Council of Economic Advisors. So I wanted to talk a little bit from my sort of public sector experience, how I think it's sort of crucial. It's not really a choice, in my view, whether you want to adopt AI assisting your drug development programs. So the Inflation Reduction Act, which was implemented in the Biden administration, had a lot of impact on new drug development. We predicted at the time 135 drugs would be lost the next 20 years. CBO predicted 5. Earnings calls by companies have indicated that we're already up to about 30 of those being dropped in the development program due to the Inflation Reduction Act. What that means is essentially that the lower earnings enabled by or induced by this legislation will have the consequence that you would need to lower your R&D cost to obtain the same returns, essentially. Most favored nation pricing coming in is even worse because it's a pricing that takes effect from launch as opposed to the Inflation Reduction Act's price controls, which also were only at the end of the product life cycle. So that will be even more R&D effect or severe R&D effect. The president obviously sent out a letter for the companies to come back with something September 29th. That's now passed. It's not clear exactly what implication that will have. In addition, FDA is launching a lot of ad restrictions, which will cut the market size for successful drugs if you can't market them freely. That will also cut R&D, obviously. Many people mistakenly think that we should just take ad dollars and therefore we should increase R&D by not spending on marketing. That's the opposite to how economists would think about it, because marketing expands market size and therefore increases R&D spending to try to obtain that market for clinical trials or drug testing. So I think as is probably known by this group, this takes about $2 to $3 billion roughly to bring a successful drug to market. That doesn't mean each successful drug takes 2 to 3 billion. That means including all the cost of failure, which is the biggest cost per drug succeeding that exists out there. So the rate of return on R&D investments for drugs, about 2/3 of which are clinical trial expenses, are obviously driven by the cost of development relative to the expected earnings. AI will have an enormous impact on both the cost and the expected earnings, presumably by eliminating more spending on eliminating spending on failed trials that shouldn't be taking place by screening them out, but also by raising expected earnings. Currently, like it was mentioned, 1 out of 10 from IND to market only make it from IND to market. So there's a 90% chance of failure from IND to markets. Phase and drug class specific failures are about 50%. So if you take that times 3, you get around 12% from start to finish. So if you're more certain that you will have a successful trial, that obviously raises the expected earnings in the future, because expected earnings are driven by the probability of success times essentially what's the earnings conditional on making it to market. So I think it's, the non-adopters are going to be left behind here, because you have to, given this earnings pressure out there that's taking place, you have to cut your R&D costs. It's not a matter of if you want to or not. You almost have to. And the question is, how do you cut those R&D costs most efficiently? And I think AI is by far the primary candidate for undertaking that job. So I will stop there with some general comments, but Greg will be happy to take over.
Well, thank you very much, Thomas. Hi, everybody. I'm Greg Sarafin. I have a 40-year career in technology and professional services. The last 20, I had large roles at Bearing Point, IBM, and most recently, I was a part of the global leadership team at EY. We're responsible for all of our technology partnerships and the technology businesses we built with those partners. Upon retirement, I have started an advisory business where I am helping companies think about how AI is going to cause the value chains in which they are operating to be completely re-engineered, and also how it is going to change the capital framework in which those value chains operate, and thus the capital allocation strategy of those companies. Like Hartaj, I am relatively new to GATC, but I came across them because in my work, it was clear to me that the value chain that not only had the biggest capital efficiency opportunity, but also the largest social impact opportunity, obviously, was the drug discovery and pharma value chain. And so, certainly I'm not the only technology executive, by the way, that's talking about this. You can't run a podcast or a news feed today without hearing some superstar tech CEO talk about this. Most recently, Demis Hassabis, who you should all know is the CEO of DeepMind, said on 60 Minutes, it takes on average 10 years and billions of dollars to develop just one drug. We can maybe reduce that down to months or even weeks. In an episode just last week on Moonshots, Pierre Diamandis said 150 small molecule drugs were discovered via AI first in 2025 alone. And at least 21 drugs have completed phase 1 successfully with a success rate of 80 to 90%, which is stunning. And that is very good for a phase 1 success rate. I think they're closer to 70% on average. So certainly a step forward, but an incremental step. It became very clear to me after surveying the industry, including GATC and the process that they'll take us through, that the secret to using AI is not just to come up with more molecules in the small molecule business, right? All you're doing is stuffing a lot more molecules into the front of the pipeline. What is really the impactful thing is that you can tell using AI which of those molecules is highly likely to be approved all the way through phase 3 clinical trials before any significant capital has been deployed, right? That is the real superpower here. It's not just generating more molecules. It's then being able to say which of those molecules statistically is going to get through all those clinical trials and result in an FDA or other regulatory approved product. So if we just look at the industry today before AI, it's pretty inefficient. Just in round numbers, research suggests that 70% of molecules are likely to pass through phase 1 successfully. Of those, 50% are likely to then get through phase 2, and of those, 30% are likely to get through phase 3. So what does that mean? It means that 1 out of every 10 funded molecules reaches the market, and only a subset of those are even blockbusters. So what is pharma? Pharma is actually a closed venture capital ecosystem. If you just look at it from the outside in, it's deploying risk funds on a 10-year cycle to yield returns for 1 in every 10 investments. Using AI to increase the rate at which molecules are discovered won't dramatically change that constraint. The constraint is it is a risk capital business. It is not a working capital business. So the thing that really was the aha moment for me when I tripped across GATC was that their technology changes the math, right? So with their technology, they can, with 90% accuracy, determine whether a molecule will pass phase 3 prior to entering phase 1. So now all of a sudden, pharma companies that are just looking at post-phase 1 for their pipeline can go to pre-phase 1 and look at a much broader population. But it doesn't stop there. Probably the most important thing that I realize is that if 90% is the new target accuracy, we have now improved capital efficiency by 9x, right? 10% probable success versus 90% probable success is massively different. And what that means to all of you that are raising capital in your pharma companies to fund the clinical trials, you now can unlock more traditional sources of capital to underwrite that growth and capacity, right? You're no longer going and saying, hey, we have something that has a 1 in 10 chance of being successful. Our portfolio, 9 out of 10 will be successful, is a different capital allocation and capital raising opportunity. There are some other interesting things that this AI technology turns out to be able to do. Molecules that are currently stuck in clinical trials are not showing efficacy, can be re-engineered so that the capital is not lost and we can recover value of the chain. There are also other uses of these types of AI technologies, including extending the life of molecules by finding combination with off-patent molecules, ideally, that address new conditions. But I think probably the other really interesting thing that pharma is going to experience as AI is deployed in this manner is this final piece, which is given appropriate science and data and a target condition, let's say it's ALS, GATC can engineer compounds for those specific conditions. And again, with that 90% likelihood of success. And what that means to the pharma industry is instead of sort of relying on what happens to be coming through the pipeline and sort of optimizing that, now the focus can be changed to, okay, we're now going to engineer what goes into the pipeline to address the markets that we think are important and purposeful for us to address. So, as I look at this, I think we are at the point now where the pharma value chain really is about to get the benefits of AI that have been talked about for years. 9 times capital efficiency, going from risk capital, working capital, unlocking sources of capital, investing capacity, all while shaping the portfolio of molecules around strategic markets and interests. We think this is truly game-changing, and now I'm going to hand you off to Ty, who can tell you a little bit more about GATC and what they are doing. Ty?
Yeah, thanks, Greg. Thanks, Thomas and Hartaj. I mean, so with these two gentlemen, painting the picture, I don't think anyone on this call in the biotech industry is not familiar with the struggles that are happening right now, more so than in past years. So I'm going to paint a picture of what GATC Health's AI platform is doing today to provide tools that empower biotech executives to be informed sooner to make more critical decisions with greater confidence. Because that's really if I had to say there's one theme that I keep hearing from what I was hearing from Thomas and Greg and Hartaj is there's so much uncertainty in the decision-making process. And the outcome of whether it be capital decisions or science decisions have such massive binary business models associated with it. The only way to fix this is by understanding what's going to happen in the future based on decisions that are made today. I mean, that's ultimately what we're trying to do. So what if you could predict with a high level of accuracy and detail what your drug's clinical results would be before the clinical trial? That would have massive capital decision-making benefits. It would have huge benefits in terms of transparency and confidence with your shareholder and investor base. Of course, it would have huge benefit in terms of the results and the revenue potential for your company. So I'm going to take a couple of minutes here to introduce a new AI report that's actually been in the market for a while, but it's being launched now by GATC Health. It's helping biotech executives today make informed decisions with confidence long before committing to clinical trials. And the report is called De-Risk with a Q. And De-Risk is the first AI report for predictive risk intelligence. So the De-Risk AI report, it uses GATC Health's technology. This has been in use for over a dozen years. It models human physiology, as Hartaj says, and it's been confirmed by the University of California, Irvine, to predict safety and efficacy with about 90% accuracy in a retrospective study, which is available on our website. It's also the platform and the technology that's used by Lloyd's of London, as you know, one of the largest and most respected insurance brands in the world, to evaluate clinical trial outcomes for their first ever clinical trial insurance program. So you've got a major university who's done a very substantial retrospective study across many therapeutic areas, drug candidates that had passed, failed, different levels in between. You've got a major financial institution that's all about risk prediction, that's using our platform exclusively to predict risk, to back up insurance programs for loans for biotech companies. So de-risk does exactly what it says. It de-risks the decision making anywhere in the development timeline by accurately predicting safety, efficacy, and potential off-target effects. So think of it this way. It's like just like the FICO score, standardized credit risk, and Carfax, the Carfax report provides objective information on cars. De-risk, the report, is creating the first objective, accurate readout for drug development, as many benefits as we've said. So the report, it's already been tested. It's in use today. We have clients, we have testimonials, we have feedback. So de-risk doesn't require these typical commitments that we're hearing from AI companies, where these lengthy, long-term collaborative AI integrate processes into your business model. That's not required for this. This is a product that's delivered and owned by the client that seeks that report. It takes about 3 to 4 weeks to deliver it. It's a comprehensive, detailed analysis of your drug candidate against your endpoints, your clinical trial endpoints. And it's specifically designed for the client to answer specific questions that they have about their drug performing in a clinical trial, with the detail that an executive science team, investment team would need to make those critical, timely decisions. So what does it do? What does it include? It includes accurate prediction of clinical trial endpoints, safety, efficacy predictions in detail, off-target risk analysis that helps with patient selection strategy for clinical trial design. And there's a summary sections for executive review, but also, of course, deep dive data for the science teams to make decisions and evaluate risk. So what our clients have been using this for, things like smarter trial design, how do you use AI, the analysis in the report, in the de-risk report, to design more efficient, targeted trials, reducing the investor risk. There's just like for Lloyd's of London and investors, there's a number of investors that are looking at this report to say, how do I de-risk an investment decision before I make it? Of course, for CEOs, how do I maximize my capital efficiency? How do I focus my resources on those high potential assets like pipeline prioritization? And of course, just evaluating and elevating, kind of leveling up the whole strategic planning process. So one of our clients, I'll give you an example. One of our clients, of course, ran a report, a de-risk report. They're a clinical stage oncology company, and they were preparing for a therapy for a late stage development and needed some objective validation data for prioritizing cancer indications. And also, they wanted to use it to support their fundraising. So they're saying, hey, wait a second, if this is the similar report and technology that's used by Lloyd's of London, why can't I hand this to my potential investors and say, well, if it's good enough for Lloyd's of London, is it good enough for you guys? So de-risk delivered to them an in-depth safety, efficacy, and off-target predictions for 2 different forms of cancer, which allowed them to very quickly select high potential indications and also to optimize their clinical trial protocols and design. We also, through the de-risk report, identified a critical safety concern that was really more like a non-obvious side effect concern that caused rashes in earlier clinical trial design or clinical trial outcomes. And our platform was able to recommend a simple antihistamine cotherapy, which expanded that patient eligibility and mitigated that trial risk. So there was a very impactful risk identification and mitigation within that report. So the company was then able to, with a lot of confidence now, expand into new indications, optimize their trial protocol, all before enrolling the patients, all before completing the design and committing to the clinical trial. So there's many ways that de-risk can assist executive level decision making. It de-risks the way R&D capital is used by identifying the most promising drug programs earlier. Like Greg was saying, yes, it's great to use AI to discover new drugs, but how important it is for these biotech companies out there that have multiple drugs in various stages of clinical trials to determine which is the one that they really need to put all their dollars and efforts behind. Because as we all know, if there's a failure, everything that happens after that is going to be suspect and greatly at risk, at least in the eyes of the investor. So using this report to also look at ways to cut spending that's unnecessary, so you're focusing on those trials most likely to succeed. De-risk also provides these actionable insights about safety, effectiveness, and these potential side effects before the clinical data is available. So this can happen pre-IND, it can happen pre-phase 3. So we have success cases where we can look at the previous data. Of course, we have a tremendous amount of data and decision-making capabilities in our models, so we can predict these things happening with more confidence. So de-risk also improves trial design. So it enables your research team to simulate clinical trial outcomes before committing the capital to a clinical trial. So just think about the power of that. So it helps focus on the right endpoints, helping find the best patient groups, refine selection criteria, et cetera. So it uncovers those hidden risks, those non-obvious risks, and of course, new opportunities that give you as a biotech executive or investor that confidence to build your overall strategy. I'd like to provide a quote from one of our clients, Lisata Therapeutics, Dr. David Mazzo, the president and CEO. I'm going to quote him. So, quote, "De-risk is a powerful new tool to help us reduce uncertainty and improve efficiency of research, development, and strategic decisions. De-risk provides an assessment based on simulation of human biology of how drug candidates should be expected to perform in clinical trials," unquote. So to reiterate, before a dollar is spent, before you commit to that clinical trial design, before you go out with confidence to raise capital, that de-risk AI report that you have in front of you can give you that validated readout on drug safety, efficacy, risk. So just as I said, just as the FICO score revolutionized credit discretions or decision making, this de-risk report is transforming how the industry evaluates therapeutic potential. So I'm going to pause there. I know we have a number of questions coming up, but looking forward to sharing more with you. Thank you.
Great, Ty. Really appreciate it. I'll ask all the panelists to unmute their mics and also just get back on, because we'll do some Q&A now. This will be the fun part, because I know we've been practicing hard for our presentations, and so now it'll be a little bit more off the cuff, and let's have also a little bit of fun. Thomas, I'll start with you. You've been talking about the IRA and the MFN policy environment, most likely to shift in the next 12 to 18 months. What should small cap biotechs plan for now? And I just have a follow up on that also with Ty after Thomas, you've answered.
I mean, it's very hard with this administration to plan anything, because things happen overnight, So we saw the tariffs of pharmaceuticals at 100% come in, where some of us kind of knew what was going on. But I mean, for the people running their companies, they don't have time to keep track of policy in DC, and it's pretty hard to deal with that uncertainty. But I think also that's why investors are a little bit cautious now. So I think the key is here for, it's a very poor investor environment now, and the reason is there's so much uncertainty in the earnings. So you need to lower, like I said before, you need to lower your R&D costs to deal with that earnings uncertainty, essentially, in order to have a survivability in your enterprise. And I think that's the key for both large and small. And it doesn't just apply to small caps, it also applies to the larger guys, that they have to deal with this uncertainty that's coming in a way that puts a lot of pressure on earnings uncertainty, and therefore puts a lot of pressure on how big your R&D investments can be. So if they can be reduced and also the risk reduced, that is kind of essential for dealing with this uncertainty.
Yeah, Thomas, that is great. So, Ty, I'll ask you the follow-up question. And, this is also kind of harks back to an observation I made earlier in the script. And I didn't actually, talk about the company names themselves, but a lot of the small cap companies, almost mid caps now that have done IPOs are focused on small molecule drug development. And when the IRA first came along, there was a belief that small molecule drug development would be the most, it would be really hurt because the exclusivity timeframes for small molecules was less than for biologics, right? And so, Ty, I want to ask you this, and then Thomas, maybe you can finish it off. Is that it seems like AI is uniquely advantageous to small molecule drug development. Ty, would you agree with this? And so, therefore, the IRA downsides to small molecule drug development might not be so bad.
Yeah, and I will kind of start out by saying that at least our AI platform and maybe others, it not only looks at small molecules, but we can look at biologics and kind of anything between. Yeah, I mean, at the end of the day, everything we're talking here about is how do we mitigate risk. So, when Thomas was talking about, the regulatory changes happening, if you see it in the paper, if not, I will tell you this administration and the regulatory bodies are looking very, very closely to introduce AI. So as far as small molecules and other therapeutic solutions, AI is perfectly poised for small molecule discovery, development, and de-risking.
Well, I mean, the key for me is that when you have all this uncertainty about earnings, which is policy uncertainty about earnings, essentially, it's policy-induced uncertainty many times. Unfortunately, our governments are not working in our favor many times. But when you have that policy uncertainty on earnings, you have to reduce development uncertainty to accommodate that. Otherwise, you're not going to have a sustainable business model. So the fact that you have all this uncertainty of earnings forces you, essentially, you can live with a lot of development uncertainty if you have a great return once you get to the market, or great and certain return once you get to the market. You can't live with a lot of development uncertainty or 90% of things failing when you go to the market and you don't know exactly how much you're going to earn. So I think that's the crucial aspect here that drives you towards AI, is all this policy uncertainty that we're unfortunately are facing.
Yeah. And I want to add to that. I mean, Thomas, that's such a crucial point because the buzz that I'm hearing about is how does AI help discover more drugs and fill up that pipeline? And that's great. But you said it, Greg said it, Hartaj said it, at the end of the day, where the rubber meets the road is right now with a third of the companies with negative enterprise value. They're not looking at what they're going to put in the pipeline in 3 years. They're looking about how do I take what's in the pipeline today? Do I need to tweak it, modify it? Do I need to modify the clinical trial design? What do I need to do to increase my success this fiscal year? Yeah.
Ty, fantastic. Thomas, fantastic. Thomas, I will say, as an ex-analyst on Wall Street, your point is really important because I think a lot of generalist investors that are not into biotech right now would probably appreciate this, that, AI could actually help by reducing earnings uncertainty, could actually help them look at the sector a little bit more favorably. So now just pivoting to Greg, Greg, I think of your perspective as a person who has these maps where you've kind of seen in other industries what the paths, companies, entire subsectors within that industry have taken. And so therefore now looking at biotech, you can apply some of this sort of like this, for lack of a better metaphor, this map knowledge, to see how, what would separate sort of early adopters who capture efficiency from teams that kind of sort of get stuck in pilots in the biotech arena, if that makes sense, that question.
It does. So let me touch on that. But before that, I also want to respond to something Thomas said that I think is really important, right? So Thomas made the point that, hey, if you're a biotech that you're really good at getting that 1 out of 10 right every time, and you get close to a home run every time, you can have 90% failure and run a power law business, because that's really what you're running. You're running a power law business, right? But I think there's a social cost to that too, right? Because those 90% failures for capital using these new AI technologies could have been successes. right? And as a person who suffers from something that is not really treatable with good efficacy, as a person, all of you, I'm sure, have lost people to diseases and conditions where you go, why? Why in this world would we ever lose somebody to that? Why isn't that fixed yet? To me, there's a bigger macro thing here for all of us, and that is how do we deploy capital for the good of society, not just the good of shareholders? So I just want to make sure we make that point. And then, coming back to
Yeah.
the thing
Greg,
that,
I can
yeah,
repeat that question if you want. It's just
yeah,
how,
if you
what's
wouldn't mind, I kind of went sideways there. I
no, no,
appreciate
no,
it.
no worries. No, it's a great point. Really great point. I love your point. What separates early adopters who capture efficiency from teams that get stuck in pilots?
Well, as a general statement, I don't care what the industry is. If there is if there's an S curve induced pivot in the value chain of the industry, and you don't make that pivot, you're done, right? Everybody points to Blockbuster, Kodak. You can go throughout history, right? Now, am I saying a whole bunch of pharma companies are going to go out of business if they don't quickly adopt this? Probably not. They have quite big portfolios and, equity and everything else. But if you're looking forward, right? Look at a company like Intel. Use the tech industry. Intel's much in the news lately. Why is it in the news? Because they made a decision 20 years ago not to pay attention to an S curve, which was mobile. And they didn't invest in smaller, more power efficient chips. And so they became irrelevant in mobile. And then they also became relevant another generation later in GPUs, in AI chips, right? So those are decisions. Intel's a big company. It still exists, but we're rescuing it now, to be clear, because it's foundational to our national defense and our strategy as a country. So again, big pharma companies, maybe they adopt it, maybe they don't. This is an opportunity, I think, actually for the smaller, more nimble pharma companies to all of a sudden become so much more capitally efficient and then be able to attract capital. So here's the other thing, right? Capital goes to where they can price the risk, right? Venture capital, a 1 in 10 chance of a success, and we're not even sure how big that success is going to be, versus 9 out of 10 things that I deploy capital to are going to yield a return. That's a portfolio business. That's working capital, not risk capital. You can debt fund it. There are many ways now that you can, as a smaller, nimbler pharma company, take future share away from the giants if that's what you choose to do. So I think it's a really interesting point in time. Decisions are being made today will show up 5, 10, and 20 years from now. And those shareholders will be the beneficiaries down the line.
Greg, these are great points. I mean, while you were talking about, various companies that were sort of, there was a word very popular a couple of decades ago called disintermediated, right? I don't know if you remember.
I used it many times.
Internet version 1.0, they love that was the word of choice, but I remember in business school in the late 90s reading case studies about how the actual old chemical industry that used to make actually pharmaceuticals got disintermediated by the pharmaceutical industry that sort of arose a lot of it in New Jersey, and various parts of Europe, and now biotech might be doing that, to various parts of the pharma industry. And to your point, AI and biotech together could do it to the old incumbents. So I think your point is very fair.
Yeah, and one other thing I'd make related to that is, what is a pharma company? Is it a science company, or is it a healthcare product distribution company? Right? Certainly the big pharma companies are massive aggregators of distribution, right? And so, if I was looking at the market from their perspective, it's like the more product I can get through my massive distribution, the better off my shareholders are. Right now, I can only get 1 in 10 things through. What if I can get 9 in 10 things through? I win all day long. So that's how I'm thinking about it if I'm a large pharma company. If I'm a smaller, nimbler, how do I use the fact that I can now engineer molecules using this technology for specific conditions, assuming I have the data and science available for the AI to work upon, right? So now you can have pharma companies who go, you know what? I am going to go after a set of related conditions, as an example, right? To really target a big, meaningful piece of the market. So I think there's all these interesting dynamics here that are going to play out again over a generation, but today is when it starts.
Great points, Greg. Really, really great. Just going back to Ty, what inputs are required for a de-risk report? How can you ensure clinical relevance and reproducibility across indications?
Yeah, great question. So basically, the data that is already publicly available around that indication, likely we already have it. If not, we'll work with the client to make sure we've ingested that. We have a tremendous amount of data already on our platform. Plus, our platform generates its own data to create models. So what we would need from the client is the data specific from their drug candidate, and it's basically things you would expect that they would already have associated with their drug candidate. So we would use that to create the model specific to the question they want to ask, and then so it's a very simple process. We've done it numerous times. We've never had hiccups on it. We have a very safe way of transferring the data that we receive and capturing that data, giving the report back to the client. It's an iterative process, so it's not like we just put it in, press a button, send it back. We have several meetings with the client to make sure we understand the problem they have or the question they want answered or questions they want answered. And then we run the initial analysis. We have that collaborative discussion with the client to make sure this is, because we're sending them a report, right? This is something that is tangible, that's actionable. So we want to make sure what they're receiving is written in the way that's going to not only answer the questions they have, but it's usable for the decisions they have to make now about the future of their drug candidate.
Yep.
I mean, I want to emphasize this too. I think this is super important because so many of the biotech CEOs and executives that I've met with, that we probably all met with, there's a lot of deer in the headlights going on. AI is like, oh my gosh, I get 5 calls a week. I've got, reviewed these long form agreements. Everybody wants to collaborate and do drug. Look, at the end of the day, that's all possible. We can do that. But what we've got is something that in literally weeks, in less than a month, they can have a very detailed report. And then the relationship at that point is over. They now have something they can give to their board, give to their shareholders, give to their science team, and they can be in the AI game without having to make these long-term commitments.
Just as a quick follow-up to that, and that's great description. One of the things I've learned in this, new iteration as sort of like an advisory business is that, you want to get C-level executives and boards involved, but there's also sort of like, the next level and fewer level belows of employees, and your report can impact them also, right? And so how does de-risk take that into account? How does GATC take that into account?
Well, I mean, the report is extremely detailed. So it does give that executive summary and the insights about risk. And we basically give a very high level rating, like almost like a report card rating based on a lot of criteria. But then you can dig very deep into each of those, the safety, the efficacy, those kind of non-obvious off-target effects. So that would enable, say, the clinical design team to understand, how do I do patient selection? Am I going after the right indication? How do I design my trial in such a way that it's set up for greater success? Should I abandon the project? I mean, do I need to really go back to the whiteboard because, whether it be the drug candidate or the targets, there's something off that I need to look at, maybe a different indication. So it's many ways that different science teams, business development teams, executive teams can use the report to make decisions.
Yeah. And I actually asked that question, Ty, because I kind of want to make a point also as a follow-up, which is that, in most industries, AI is sort of like, scary. A lot of people think it could take their jobs, et cetera, et cetera. In biotech, and I think a lot of other people have opined on this, like biotech, AI can really help. And to your point, and I think the point that Thomas have made, Greg have made, our bar now is so low in terms of success rates. And that curve hasn't bent in a while, in 30, 40 years. That for a company to come in and be able to provide that clarity, and conviction around decision making, even if the if the improvements are incremental, they're actually huge for biotech. As to Thomas's point, earnings visibility, we will get a bigger multiple, for the sector, et cetera, et cetera. So I think this is just really, really cool stuff. Maybe just
on that point, we've had a number of discussions with different folks across the country, inside the Beltway, et cetera. This may be one of the only industries where AI adds jobs, because we're actually, it's a tool that makes scientists smarter, business people making investment decisions better. But if we have, to these guys' points, if we have more drugs and advanced clinical trials, that's more people that need to be involved to push those through the clinical trial process.
Right.
Yep. Now, just going to the panel, and maybe start with Thomas first, and then Greg and Ty, you can take it from there. But we'd love to get all three of your perspective. There's just a broader question. If AI could give you a guaranteed true answer to one unsolved question in biology, what would you ask? And you can even talk about it as a non-biologist.
Yeah, no, I'm not a biologist, so I can't make that kind of a statement. But I do think it's a very important point here, which is that, and that touches on Greg's point as well, which is once we have more efficient capital coming into testing drugs, we will get a lot more testing. So, it's going to be, even though the earnings forecasts are very dim out there with the policy changes taking place, the return on capital might actually go up if the development improvements outpace the earnings reductions, essentially. So I think that's very, very important, because, ultimately we want better treatments for more patients, whether it's large diseases or rare diseases. And if this sort of a cosmic shift in how development is performed is as successful as we think it will be, this is going to be a massive inflow of capital once you have success on that capital increasing, as opposed to just failing all over the place.
Yeah.
Greg or Ty, I'll say the question again. If you could have a guaranteed true answer to one unsolved question in biology, what would you ask?
Yeah, again, I'm not a scientist either. I don't want to be a cop out here, but I don't think you can pigeonhole the ability to predict the future. I mean, I don't think it's the answer is whatever question that the CEO is having a discussion with the board of directors and their chief science officer, whatever that thing that's keeping them up at night, because they don't know if they should commit dollars and resources and tell their investment community they're moving forward on program X. That's the thing that we can help them with.
Yeah, and I'll also fail to answer the question, but I'll answer a different question.
No, Greg, that's fine.
The same reason. I mean, look, if you ask me personally, it's longevity. I'd like to see us solve longevity, right? But that's not one thing. That's a lot of things that have to be solved, right? So I don't pretend to know which is the most important thing to solve to get there. I would make this point. I think you were touching on it too, Hartaj. A lot of times we think about technology as sort of these glorious, sexy things like robots and spaceships that get caught by arms and beautiful phones that we can talk to, like it's a therapist and all this other stuff. But it turns out there's some pretty use of that technology where it's just price risk. If you had a piece of technology that could price the risk of every stock you want to buy with 90% accurately, would you buy? Would you use the product? And how much would you pay for it? That's what we're talking about here, right? It's simple. It's not, you don't have to integrate your workflows. You don't do all this nonsense. It's a simple piece of technology. I don't want to, so actually it's not simple. I did see some of what they've done over the years. There's a lot going on underneath of it. But from your perspective as a user, it is simple. Give me the data and the science. I will price the risk. That to me is a brilliant use of AI, and it is going to be game changing in this industry. And I can't wait to see what happens.
Yeah. Greg, that's fantastic. I mean, look, as a biologist, I'm not a PhD or MD by training, but, for example, if D-Risk or GATC Health, can help a company understand whether a biologic target, right? Like, PD-L1, previously a new target checkpoint in some kind of inhibitor or inhibition target. If you can help, teams get a go, no-go decision, that doesn't just help there, because the beauty about biology is that once you understand one target, you understand its upstream and downstream effects really well. So if you can help like kind of figure out one node, because biology, the way that biology works, we don't just figure out one thing at a time. Everything has to be sort of like make sense together. The scaling factor is actually huge, which is why, again, I get really excited about AI, because I think in biology especially, it will have some really, massive, and I don't want to use that word lightly, ramifications. Going to the next question, we've got about 7 minutes left, so not really Final Jeopardy right now, but maybe in a couple of minutes. So you can still extemporize a little bit, and then we'll go to Final Jeopardy. Just for the panel again, how should management communicate AI-derived predictions to the street and to the FDA without overclaiming? Greg, maybe if you could start.
Well, I'm a big believer in transparency. So if you're going to make a claim, you provide the underlying basis of the claim, which is the report, which is very detailed. The report is also accepted by Lloyd's of London as something that they do their underwriting for. So I think it's actually a fairly straightforward path to say, look, we've adopted this new technology from the services company. Lloyd's use it, other companies use it. This is what the report says. We now have a much better way of pricing the risk than we did before. Is it 100%? No, nothing's 100%. But is it 9 times better than what we had before? Yes, it is.
Yeah, someone told me once the bar isn't that high.
That's better said.
Yeah.
I'm very proud of our industry, but well said. The bar is not that high in biotech. And then, just another one to the panel. Ty, maybe, I think you've been probably thinking about this, but maybe start off with you. What is one metric you would watch to judge whether Biotech 2.0 is taking hold over the next year, over the next, couple of years?
Ooh, that's a great question. I think for me, it would be, I think what I've been hearing is that it keeps going way upstream to the investor. So, yes, science decisions, crucial, clinical trial design, crucial, go, no go decisions by the management team of biotech, crucial. But at the end of the day, I think we've all been saying this whole engine runs on the gas of investment. So I think once we see, and we're already seeing this, once we see the investment community, whether it be for follow-on investment or initial investment or acquisition or even rescue, or even, pulling drugs out of bankruptcy. I mean, any of those decision-making processes that would involve an investment using something like the de-risk report, them using that is going to be a huge indication of shift all the way downstream.
Thomas or Greg, you don't have to chime in, but if you wanted to, otherwise we can just go to the next question.
I mean, I think ultimately what's going to happen is that the people who are successful in bringing their drugs to market is going to be more reliant on this new technology, right? So once that is understood, there are going to be studies or, analysis showing that successful candidates relied on AI to either discover the drug or on go, no-go decisions, whatever, and compared to guys who didn't use AI who failed more often, essentially. And then once that data starts coming out, there's going to be more and more adoption towards which it will drive, not universal adoption, but high adoption of these technologies to aid the development.
Great.
I would say at the macro level, what I would hope happens is as the industry realizes the capability of this technology, and more broadly, the capital community recognizes it, we will see a huge flow of capital into drug discovery. Right now, capital is either sitting on the sidelines or it's all trying to get to the same place, energy, data centers, and GPUs. We can't all get on the cap table of SpaceX or CoreWeave. Well, I guess we can buy CoreWeave stock now, so that's probably a bad example. But the point is, we now have a new class of asset that capital can flow to. And it happens to be one of the four industries that, should be considered a national imperative. And therefore, we have a repatriation of manufacturing here as well, right? And tying into that whole investment thesis of the current administration. So I think there is a huge opportunity for us.
Yeah. It's almost like this. I mean, I always think about what's the inevitable end result of all of this when it comes to fruition. It's just like, again, would you go buy a used car without seeing a Carfax report? Would you make a credit decision without seeing a FICO score from an individual? And it's going to become inevitable that you can't make a capital investment decision without having a D-risk report.
Oh, that's great, Ty. We got a question from an investor, John Doe. I hope I'm saying this the right way. D-O-U-X, John Doe at Palo Alto. It's a long question, so I'll repeat it if I have to. How does AI handle indications for which product services have never been developed or commercialized or have been minimally studied? What data sets would have to be trained on to address something with a paucity of historical data in order, for the AI report to extrapolate?
Yeah, that's a great question and a longer answer. I'm going to give it a tight answer, which is we've been in that situation many times with very good outcomes. We don't need we want multi-omics data, but we don't need a large patient set. Our system, our AI models, there's many AI models that make this up, that it basically models healthy human physiology in massive detail. Then we introduce the disease, basically exogenous data, into that healthy model and then see what happens. And then how do we return that unhealthy model back to homeostasis? So we don't have to know it. Wonderful. If it's a new indication, if it's something new, we love that. I mean, that's how we break through.
Yeah. Ty, that's fantastic. It actually reminds me of in biology how we do some things, which is we introduce a disease into an animal, right? And then give it various drugs and see how the animal responds to that. So in some ways, it's, biologists will get your pitch. I mean, it makes just sense. So, with that, we're at a minute, to the hour. I'll just sort of close our webinar here. We've had a really exciting conversation. I hope we have more of these and GATC Health participates. Thank you to our panel. Thank you to all of you for joining this inaugural astr60. If there's one takeaway, it is that Biotech 2.0 is underway. I really do believe that. Disciplined capital, clear endpoints, and credible prediction tools, these can bend the curve of risk and time. Smarter biotech, better outcomes. Now, just a practical matter, you will receive a follow-up with replay and one-page takeaways. We welcome your feedback on topics for the next session. So again, thank you to the panelists, to GATC Health, Astr Partners for making this webinar possible, to our audience for taking the time out of your day to join us. A special thanks to the astr60 team, all the folks behind this screen who've been working tirelessly to make this possible. Really, it's because of you that we can have these really great conversations in what seems to be a seamless way. So thank you so much, everybody. Have a great day and talk soon.
Thank you, everyone.